Hi students, welcome to the video on financial and management accounting at your fingertips. The most important topic is depreciation accounting. We have already solved two problems. This is the third problem we have to solve. So, books of X Limited showed the following balances on 1st April 2023. So, machinery showing rupees 5 lakh, provision for depreciation account showing 2 lakhs. On 1st April 2023, a machine which had a cost of 1 lakh on 1st October 2020 was sold for 40,000. The firm writes up depreciation under diminishing balance or reducing written down value method, and its accounts are made up on 31st March each year. You are required to prepare the machinery account and provision for depreciation on machinery account for the year ended 31st March 2024. So here there are three things. One is machinery account, then second one is provision for depreciation. Here provision is kept for replacement of machinery, so that is provision for depreciation accounts. Then this provision for depreciation will be adjusted out of depreciation account. That means while purchasing the machinery, we have to do machinery account debited to bank. While keeping provision, we have to write provision for depreciation account debited to machinery. Like this we have to solve. So here on 1st April 2023, a machine which had cost 1 lakh. So here we have to do working note and calculate whether there is profit or loss on sale of that machine. So cost of machine on 1st October 2020, 1 lakh. 1st October 2020, it was 1 lakh. Here depreciation, less depreciation for 6 months or 6 months. So 6 months depreciation is, that is depreciation rate of interest is, here it is say 10%. 10%. So 10% is the rate of depreciation per year. 10% means 10,000 per year. For 6 months it is 5,000. So the book value on or written down value on 1/4/21 is 95,000. Less depreciation for 1 year. For 1 year, that is 10%, 9,500. Then the written down value or book value on 1st April 2022, it is 500, then 85,500. Then this is on machine which cost 1 lakh on 1st of 2020 was sold on 1st April 2023. So less depreciation for 1 year. Depreciation for 1 year, that is 8,550. So written down value or book value on 1st April 2023 is equal to 76,950. 76,950 is the written down value of that machinery. So sales price is how much? It is 40,000. So loss on sale of machinery, loss on sale is 36,950. So here we have to only for 1 year it is given. So we have to write, this is 1st April 23. So 1st April 23, right? It is asset opening balance is 5 lakh. So write to balance brought down. This is 5 lakhs. Then provision for depreciation, it is credit balance. So on 1st April 23, accumulated depreciation is accumulated provision for depreciation 2 lakh. So write by balance brought down. The amount is 2 lakhs. So here on 1st April 23, the firm is Mr. X is selling the machinery. So by bank account he is selling for, that is sales proceeds. He is selling for 40,000. Then by provision for depreciation on machinery, by provision for depreciation on machinery, how much it is? Here first year 5,000, then 9,500, then 8,550. Total comes to, so 14,500 plus 8,550. So this is 23,050. So 23,050. Then by profit and loss account, that is loss on sale of machinery. So amount is 36,950. 36,950. So here posting will be done on 1st April 2023 to machinery account. The amount is, that is 23,050. Then here on 31st March 2024, the balance is by balance carried down. So amount is 4 lakhs. Because this is 1 lakh. 1 lakh. Yes. 1 lakh. 4 lakh. Then 5 lakh is done. So here the provision on 31st March 2023, we have to keep provision for machinery account debited to machinery account. Then amount is by depreciation. What is the depreciation during the year, that we have to calculate. So it is 4 lakhs minus 2 lakhs. Out of 2 lakh already adjusted 23050. So amount is, that is 4 lakh minus, that means we can write 4 lakh minus 2 lakh, that is 2 lakh plus 23,050. So the book value is 2,23,050. So depreciation at the rate of 10%, it is 22,305. 22,305. So balance is on 31st March 2023 to balance carried down. So amount is 2,22,305. Here also 2,22,305. So amount is 5 1,99,255. So this is all about the first problem. Then we have to solve the second problem. In the second problem, it is given here problem with GST. I already told you GST means goods service tax. When GST may be of two types, that is, one is intra GST, another is inter GST. In case of intra GST, the GST is of two types. One is SGST, state good service tax, then central CGST. But in case of interstate, it is named as IGST, intra GST, good service tax. So intra means within the state transaction, means both supplier and the buyer belong to same state. Interstate means among different states of the country. When we are purchasing or the supplier, when the trader is purchasing the goods, then he will debit input GST. Input GST, if it is intra, so we write input SGST, input CGST. If it is interstate, we write input IGST. This is in case of purchase of goods. When selling the goods, it will be treated as output SGST or CGST. If it is intrastate, if it is interstate, it is output IGST. And there will be right of set off that we have already discussed in the video prepared or meant for GST. You can search from YouTube Arun Kumar Dhal GST. You will find it out. Then here one problem is given with GST. X purchased a machine on 1st December 2024. So 1st December 2024, X is purchasing a machinery for 6 lakhs. So machinery, cost of machine, that is cost of machinery, it is 6 lakhs. Then GST paying 6%, CGST, SGST 6% each. So SGST input, it is input SGST 6%. 6% means 36,000. Then output SGST, input CGST. For at the time of purchasing, it will be input SGST, input CGST. CGST, it is also 6%, means both equally 6%. So total amount we have to the business have to pay to the supplier is 6,72,000. Then it is given X purchased a machine on 1st December 2024 for 6 lakh plus CGST, SGST at the rate of 6% each. He paid 30,000 for loading and unloading and carriage expenses to bring the machinery to factory. Already you should know, while purchasing a machinery, whatever the additional cost incurred to run the machinery into working condition, that is treated as capital expenditure. It will add to the cost of machinery. It cannot be treated as revenue expenditure under any circumstances. Here So loading charges is here the cost of machinery is cost of machine excluding GST, excluding GST is 6 lakhs. Then another expenditure on bringing the machinery is, that is loading, unloading, carriage expenses. Loading and unloading and carriage expenses. Amount is 30,000. Then he further incurred 25,000 for installation of machinery, that is plus installation charges. Installation charges. It is also 25,000. So the cost of machinery or machinery account will be debited with 6,55,000. So here question is given, how much amount did X pay to the vendor of machinery? So answer is A will pay 6,72,000 to the vendor of the machine. How much amount will be debited to machinery account? So machinery account will be debited with 6,55,000. 6 lakh to our cost of machine excluding GST, another 30,000 to our loading and unloading and carrying charges, carriage expenses, and 25,000 towards installation of machinery. Total comes to 6,55,000. Then third is given pass journal entries giving effect to the transaction. So we have to pass the journal entries. Sorry, 6,72,000. So journal entries, one is 6,72,000, another is 6,55,000. Okay. So journal entry we have to pass journal entries. While purchasing the machinery, so journal entries, machinery account debited, machinery account debited with, that is 6 lakhs. Then input CGST is 6%, that is at the rate of 6% means 36,000 plus input SGST, same amount, that is 6% is 36,000 to vendor's account, because it's purchasing on credit basis, nothing mentioned, it is purchasing on. He paid, so purchase a machinery, nothing is mentioned, let it be on credit basis. If it is credit basis, we will credit to vendor's account. If it is check basis, by paying check, issuing check, we will write to bank. So if it is credit basis, we will credit to vendor. If it is check basis, we will credit to bank account. Check issued. If check is issued, then while purchasing machinery, we are incurring, that is 30,000 as loading, unloading and carriage expenses, and 28,000 for installation. Total comes to 55,000. So it will be debited, it is capital nature, it will be debited to machinery account. So machinery account debited with 55,000 to bank account. Being, so narration will be being loading and unloading charges, loading and unloading and carriage expenses or bringing the machinery to factory and installation charges at factory. Debit is capitalized nature, is capitalized in nature and debited to machinery account. And credited to bank account. So this is all about these two problems. Thank you for watching the video. Don't forget to share the video to all of your friends so that everybody will be benefited. If it is up to your satisfaction, then you like the video and subscribe the video if already not subscribed.